Well, howdy there, folks. It's a buy one, get two free here tonight. 3 videos for me to react to that I'm looking very forward to. First one up here. The Bears have overstayed their welcome, says RBC's Lori. I want to get into that one. I think that's an important subject. Second one, we're actually going to react to this 3-minute clip from Powell today talking about future Fed rate increases. Okay, very important, obviously, and I'll give my opinion on that. This third video, I actually got to see this on TV. I had CNBC on in the background, so I actually got to see this personally. I'm looking forward to sharing some opinion on this one. The market has a runway to next earnings season, says Joe Terranova, which is an important subject to get into there, okay? Now, before I get into that, I just want to show you guys something very important here, okay? What I'm showing you is market cycles over time, okay? And you've seen this from the long side. But what a lot of people don't understand is short sellers and bears go through the same exact cycle. The same exact cycle that bulls go through, bears and short sellers go through as well. But the only difference is short sellers and bears go through this cycle much more often than the bulls do, right? Because 7 or 8 out of every 10 years is a good year, right? So nonetheless, if you think about where we were toward the end of 2023, right? Especially like October, when kind of a lot of stocks were bottoming out, like mid-October, bears were in complete euphoria. You had the NASDAQ fall 30+%. You had, the biggest companies in the world falling 30, 40, 50, 60, 70% in a matter of months. And this was like a blow off the top situation for bears and for short sellers, and they were in pure euphoria, right? And so now at this point in time, they started to get complacent, but now I think they're actually starting to get into this anxiety, denial, and even some are even starting to panic in this whole situation. And as the markets ticked up more and more over the last few months, more and more of these folks are starting to go from complacency to one of these 3 stages, and different folks are at different stages. And you're seeing it in the stock price moves. Believe me, this isn't just longs punching in money to these stocks. This is shorts covering heavily. When you see some of these stocks up 50 to 100% in a matter of just the past couple months, believe me, some of these folks are starting to panic in regards to these stocks. So we're starting to reach that stage. And this was a stage that the longs had to go through back in the summertime and the fall time, right? I mean, this is when you saw the greatest companies in the world falling 50, 60, 70%. A lot of the longs were all experiencing this. And so it's important to understand that shorts and bears go through the same exact thing that the longs do. It's just at different time points, right? So hope you guys enjoyed today's video. As always, I think we're at like 23,000, and I think we're almost at 23,200 subscribers on the channel now. Like, we're getting really dang close. So I appreciate every single person that has subscribed to the channel. Thanks for being here. And if you didn't know, we got our massive, epic, once a year Valentine's Day sale coming up for Becoming Master of the Stock Market course and Dividend Investing Mastery. If you want access to that deal when it drops on Valentine's Day, that flash sale, go ahead and check out the pinned comment down there, enter in your info, and I'll send it over when that deal drops. Let's get into this.
We head into the close. It's a strong session on Wall Street. Lori Calvasina joins us, head of U.S. equity strategy at RBC Capital Markets. Lori, you were looking at the market internals when Powell was speaking today in Washington. What did you notice about what popped?
So, what I was watching, Sarah, and I'll say whenever we have Fed Speak events, I always like to watch the sectors in the S&P. And what I saw today, what I was really focusing on was how tech, communication services, and consumer discretionary were acting. And that's because if you look back historically into the mid-1990s, those are the 3 sectors that have tended to perform the best in the 6-month period following final Fed rate hikes. So we really wanted to see how those sectors were acting. And as markets were rallying, we really saw those sectors take off like a rocket. So it told me that what markets were initially hearing from Powell was really the idea that we're closer to the end of this cycle. And then, of course, we saw the market take a hit. Those sectors took a hit. But then they've all, done.
Oh, I love seeing one of my stocks up there, baby. I love seeing CNBC highlight one of my stocks. It was a great day for Skyworks Solutions shareholders. Cheers to you. I think we're up, oh gosh, I mean, that's not even a huge position for me, but I think I was up like almost $10,000 today just on that stock alone. So yeah, bright future for Skyworks.
Sectors took a hit, but then they've all, done well towards the end of the day. So I think the market got a little confused and had to digest some of those later comments about the labor market, but ultimately came to the conclusion that we're still closer to the end of this hiking cycle.
And really taking off now. We're at the highs of the day. The Dow's up 300 points. The S&P 500 up 1.4%. More sectors turning green, including consumer discretionary, had been lagging because of Amazon.
Whoa, do you know what my eye just went to? Oh my gosh, okay. That baby right there, NVIDIA. Like, was NVIDIA not was Nvidia not like $120 or so, like not that long ago? Like, oh my gosh, what an insane move in Nvidia.
So, Lori, is that the right take? Are you a buyer? We've already had quite a nice rally here, 19% off the lows for the S&P.
You know, Sarah, we're a little bit above my target of 4,100, but we did say coming into this year that if there was a risk to our view, and we ended up being wrong, that we thought the risk was to the upside. And we put a piece out yesterday walking through some math on valuation saying we could see potential upside to 4,500. Now, my base case is still 4,100. I think that, you know, it's interesting, right, that we haven't had the final hike yet. Markets are already pulling back forward. So I feel like the markets have gotten a little bit ahead of themselves in here. It might be time just to exhale and take a little bit of a breather. But in general, Sarah, I find myself really pushing back against the bears in the strategy world. I think that it is quite possible that we saw the lows in October. I think we're going through that final leg of earnings downgrades right now, and markets typically bottom 3 to 6 months before you get the final earnings downgrades in. So I think we're probably preparing for a little bit of chop in here, maybe a little bit of digestion. But in general, I think the bears have overstayed their welcome.
Woo, okay, bears have overstayed their welcome. That is a big statement, okay? Here's my opinion on that. In terms of the bears, they usually overstay their welcomes, just to be quite honest, right? And from the bearish side now at this point in time, you have a ton of things starting to work against you. One is, and we're going to get into what Jerome Powell has to say here, but it seems like obviously Jerome Powell's definitely on the side of inflation's coming down. That's good steps in the right direction, right? The Fed potentially not being as aggressive, which we'll see in this video if he says that or not, right? In terms of future rate increases, if there are future rate increases, right? So you have that kind of working against you, where you had that working for you on the bear side of like those 75 basis point increases was like the best thing that could ever happen to you as a bear, right? Because that just like sends stocks down immediately. And like Jerome Powell just coming out against the market again and again and again. Best thing that could happen to you as a bear. The best thing, right? On top of that, you had earnings starting to get worse and worse as 2022 rolled along, right? The issue you have now when it comes to earnings side, I've listened to, oh gosh, a disgusting amount of earnings calls over this earnings season, right? When I'm hearing from CEO after CEO, they're still very uncertain about the future and those sorts of things. But from what I'm gathering for intel from the most important companies to S&P 500, is what I'm hearing is a lot of these companies are kind of in a trough earnings period right now, Q4, Q1, Q2, and are actually expecting things to strengthen as this year kind of ticks on. And a lot of these companies have cut some major employee spending and CapEx spending. So a lot of these companies are going to emerge in actually way better margin profiles and profitability in terms of that net income and the EPS. A lot of the biggest, most important companies, you're going to see them increase quite substantially their earnings per share and net income, which is something a lot of Wall Street doesn't even have factored in right now, okay? And if you're wondering what really drives the stock market over the long term, it's S&P 500 earnings. If you want to know what drives the S&P 500 over, a 3, 5, 7-year span, 10-year span, it's where earnings go. And you could look at any 10-year span of the S&P 500. And if the S&P 500 did really good, look what happened to S&P 500 earnings. They increased substantially. If the S&P 500 did bad, it's because S&P 500 earnings went down substantially, right? And so now as a bear, you're starting to have a lot of things start to work against you. And that makes it a very tough environment. And we haven't really seen a major uptick in overall job losses, right? We've seen, obviously, in terms of tech companies, layoffs, this company laid off 5% of their staff, 7%, 10% of their workforce, whatever, right? But we haven't really seen it in mass. And so until you have that as a bear, it's kind of like, what do you have to go off of, right? And even if you did see any job losses, then people would also look at that and say, well, good, that means, wage inflation is going to come down. So you could look at that as almost as a positive, right? And that's the tricky predicament that these bears and short sellers are in. And that's why a lot of these folks are starting to either enter denial phase, anxiety phase, or some of them are starting to panic out of these shorts and cover and say, gosh, man, I think I messed up here. And unfortunately for the ones that went super short, as in put options, those folks, their options are expiring worthless right now. Worthless. Zero. Not like, you held Tesla stock and you went down 50% on it. I'm talking these people are zero. They're lost 100% on these put options, 100%. They're so convinced that we are going to continue to tank into the first quarter of this year. And we've gotten anything but a tank in the first quarter of this year, okay? Next up, what does Jerome Powell say? This should be very important.
Known that the jobs report was going to be as strong would you have done 25 basis points or something different?
That's a good question.
David, thank you for that question, and thank you for inviting me here today. It's great to be here. So we don't get to play it that way, unfortunately. We have to, but I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. So the services sector, really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. Then comes the labor market report for January. And it's very strong. It's certainly stronger than anyone I know expected. And so, but I would say, we didn't expect it to be this strong, but I would say it kind of shows you why we think that this will be a process that takes a significant period of time. The labor market's extraordinarily strong. And by the way, it's good. It's a good thing that inflation has started to come down without it. That has not happened at the cost of a strong labor market. So, and of course, since then, financial conditions have tightened significantly since.
What he just said is extremely important, because a lot of these bears, a lot of these short sellers were banking. They were banking everything on the belief that in order to start getting inflation down, you need to destroy employment. You need to start seeing, unemployment climb to 5, 6, 7, 8%. You need to wreck this economy. Their belief was you can only get inflation down by wrecking the economy. Devastation, okay? But what we're starting to see play out now is inflation's coming down, right? We're going to likely see more 5s numbers coming over the next few months, and then eventually, hopefully, 4s, right? And you're seeing these numbers start to come down and down and down, but you're not seeing the insane job losses, the devastation that these shorts and these bears were banking on, right? And that's why it gets dangerous to bank on, certain macroeconomic things to happen for you to make money in the market, because sometimes those things aren't just going to happen, right? And you have to be able to get through that. But the problem is on the bear side, the short selling side, you have unlimited losses in front of you, right? And a lot of these folks like to play puts, which end up expiring worthless because they're time delayed, right? The longs, we can look at this and we can say, we don't care. We got the next 5 years to play. I don't care if this stock goes up or down tomorrow or the next day or the next week or the next month. Like, I have 5 years to play with. These short sellers don't have 5 years to play with. They got 5 days to play with. They got 5 weeks to play with. They need devastation now or they lose it all, right? They get absolutely obliterated and you're paying interest on your short position, and ultimately we know there's unlimited losses when you short stocks, right?
So let me ask it another way. So, by the way, when the numbers coming out, the jobs numbers, 519,000 jobs, does anybody call you up in the government and give you a little heads up this is going to happen, or they never do that?
So on some data, sometimes we get data just the night before, and it's only me, and but not on all pieces of data. It's a very small amount of data, and we get it just the night before. For example, if we were going to get a big piece of data in the middle of an FOMC meeting, as often happens on the day of an FOMC meeting, it will help me to know it the night before.
Okay, so the markets, after your speech last week, the markets assumed that therefore there would probably be another 25 basis point increase in your next FOMC meeting. Was that a bad assumption by the markets?
So what we said at the meeting was that we believe that we anticipate is what we.
He's trying to get him to slip up, man. He's trying to get him to slip up so bad.
That ongoing rate increases will be appropriate. And the reason is we're trying to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. And we don't think we've achieved that yet. So we said that, and now you see the labor market report, and I think, again, financial conditions are more well aligned with that than they were before.
So the assumption when you made your speech was that probably the Fed might even consider decreasing rates by the end of this year, and the markets no longer assume that. You think the markets are wrong?
Well, so let me say, these are all of these numbers that we're throwing around here are conditional on incoming data and what happens. So we never say this is what we think will happen. We make a tentative forecast and then we let the data come in. For example, if the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets or than we wrote down at our last group of forecasts in December, then we would certainly do that. We would certainly raise rates more.
Yeah, it's fair. That's completely fair. And, that's where these shorts and these bears, they get so mad at Powell. Like, oh, say you're going to do this. Like, you're going to raise it. And it's like, dude, chill. Like Powell's saying everything is he's going to be data dependent. And he even talks about, more rate increases coming, right? And so, what more could you want from him other than just making him straight up lies and saying, oh, we're going to take the Fed funds rate to 10% or 20%. Like, what are you looking for, right? But these shorts and these bears are so desperate because they're getting absolutely obliterated on their positions and they're losing everything on these put options, everything. And so they need Powell they're looking for some sort of miracle out of Powell to say that he's going to wreck the whole everything. And we want to see 20% unemployment. And if he doesn't say that, these bears are all in their feelings about it. It's like, dude, the man's saying everything he's got to say. And he's doing the best job possible despite people trying to get him to slip up again and again. That's why if you're wondering why everybody was laughing there, it's because everybody's aware that that gentleman's trying to get Powell to slip up and say something, that maybe he shouldn't say even if he's feeling a certain kind of way, right? Next video up here, the market has runway into next earnings season, says Joe Terranova. Let's hear what he has to say.
The day here closing pretty much on the highs. Let's ask Joe Terranova of Virtus Investment Partners. He is a CNBC contributor as well. I want your reaction to Powell because he had another chance to take a swing at the market and he didn't do it.
He sure had a chance to do it. April 5th of last year, I sat here on the desk. I told the viewers that we had an adversarial Federal Reserve. Scott, we have a Federal Reserve that no longer wants to be adversarial. And one could argue that they are not adversarial anymore because they've had two opportunities in the last week to be that way.
Well, literally, what is the man supposed to say? What is he? What do they want from him? What do they want from him, man? It cracks me up.
Do it. He also said financial conditions have tightened since the labor report.
It's kind of the thing.
Chairman Powell, what are you looking at?
I mean, he talked about conditions, right? And this was one of the issues that sent stocks surging last week on Fed decision day and the news conference, right? He had a chance there to talk about conditions softening too much, didn't do it. So this was, part two in the same old story. I thought Rich Clarida was really interesting with Sarah within the last hour. He said, quote, markets have more or less priced in a couple more hikes as the baseline, and I think that's where the Fed thinks they're going. The implication of that is the Fed and the market aren't really that offsides anymore. Peak Fed funds was at 515. Leisman was talking about that today on the halftime report. So we've solved that issue a bit too.
Correct. I think the only way there's a dislocation is if we continue to get very strong labor reports. And Chairman Powell answered at the end of his remarks what the response would be to that. You'd obviously see more rate hikes. But listen, Scott, I'm a triple-digit golf player. And last year, once, I shot in the low 90s. So we had a great labor report in January. That does not make a trend. I think that would be the only thing that would motivate the Federal Reserve to extend the rate hiking cycle beyond what the market is pricing in right now.
Forget about, more hikes. I mean, right, a couple more hikes, okay. I thought, and Sarah, she nailed this on when she was talking to Clarida, if inflation data continues to improve, I think towards the end of the year, they could be open to considering a cut. As the former Fed vice chair.
My belief on that is, yes, I do. If we see, let's say the next few months, we're going to see fives. We come in at fives. A few months after that, meaning kind of in late spring, early summer, we start to see fours consistently. And then going into fall time, we start to see threes. And it's consistent. This trend is going on, and twos are expected to be right around the corner. I wouldn't be surprised at all if they actually cut rates. Not at all, okay? If you see a clear trend downward in CPI coming in better from where it was at peak, where were we at peak? Nines? 8s, 7s, 6s, 5s, 4s, and then 3s by the end of the year, I think there's no doubt they're likely at least look to cut, especially if they felt like there was any weakness in the economy. They would have even more ammo to, at that point in time, go ahead and cut, because they're like, well, last unemployment report wasn't that strong. Like, let's say it's later this year in something like that, right? They see some worrying data. They would just give them more fuel to the fire to just say, you know what, yeah, we're going to go ahead and make a little cut here.
That, saying the quiet part out loud, right?
Well, I'm not necessarily sure. First of all, I don't think...
he's been in the room, and he has a great view of sort of how policy is set. I mean, the idea of a cut, the market had been looking for a cut later in the year. It was deemed to be no way. Fed's not going to do it. He said, all right. Well, if inflation goes down a lot, they might.
Well, you would have to see beyond inflation going down. I think you would have to see some tremors in the labor market itself. Without question, we've got a peak commodity story that's playing out. You look at the price of lumber year on year, it's down 68%. If you look at the price of crude oil year on year, it's down 40%. If you look at the price of wheat year on year, it's down 40%. Used vehicles are down. There are other areas. The one area of the market
services,
that we need to see, services,
hasn't cracked.
But it's housing too. It's really housing, and that's such a significant contributor to the inflation reading. We'll find out next Tuesday,
Maybe
Valentine's Day.
Maybe it doesn't. I mean, you get CPI, right?
You're not going to see major increases in home prices in 2023. You also, in my opinion, won't see major increases in rents in 2023. In terms of home prices, major rise, 2021 was that year, right? In the very beginning of 2022, and then that ended quickly, right? In terms of rents, they had to play catch up. So you really started to see rents increase at the very end of 2021 and then obviously 2022. And you'll see a little bit here at the beginning of 2023. But in terms of rents and home prices, both those are stabilizing to normalized ranges now at this point in time. Meaning essentially, it's possible that in future years, you're going to see home prices go up. You're going to see rents go up, but not at that ridiculous out of control clip where home prices were going up 20, 30% in a year. Rents were going up astronomically high, where it's like, how did my rent just jump 15%, 20%, 25%, right? So that's good news. We're going to get normalization in the housing market now.
8:30 a.m. next Tuesday, we'll get that.
Okay.
If housing begins to contract significantly, that disinflation story is only going to gather momentum. So,
I mean, housing's been contracting. I don't know where Joe Terranova's been, in all due respect. Housing hasn't been in a good place for 9 months plus. Housing just continued to be weak.
Did the Fed chair
look at all the home builder numbers? They've been awful in terms of their backlogs, new sales. In terms of their backlogs selling in, revenues are great, EPS is great, margins are very good for those companies. But in terms of new sales to add to the backlog, it's been non-existent.
In essence, give the rally, the market, a chance to get really up to cruising altitude at this point, at least until the next meeting?
See, the way that I would answer that is I don't view the Federal Reserve right now as the adversary of the market. I think the adversary of the market right now is the lag effect of the rate hikes and what does that do to earnings. So I look at the market right now. I do think there's upside potential for sure in the market. How do you strategically want to be allocated? We'll talk about that in a little bit. But I think the market has a runway now leading into the next earnings report. I don't think you have the all clear, though.
Earnings report, that's a lot longer than I was thinking.
No, I think for this quarter you're going to be okay, and I think that builds upon the thesis that the first half of the year is going to be better than the second half of the year.
I'll tell you what Lori Calvasina just said at the end of Closing Bell 2, quote, in general, the bears have overstayed their welcome. Is that what's happened?
I don't see how you go back to the October lows. I can't see how we make a return back to 34.91, which is where the S&P was in the middle of October, without a significant exogenous event. Does that mean that we are going to immediately trade up to the highs from last January at 4,800? I don't think so. It doesn't appear to be. That's not how I'm allocated right now, but I think the low is in place from October.
Yeah, I mean, the main issue in terms of new lows, it's getting more and more unrealistic at this point in time, right? It's always a possibility you could have a freak event happen, something like that, right? And you could always get the market to push lower. But you get the further we're going here, the more and more that's starting to look like an unrealistic thing, and even some of the bears are starting to give up on that whole thesis around that, right? But the issue I've always seen with the bears and the short sellers is never enough for those folks. It's never enough. These stocks could go down 70% and they want them down 80%. They could be down 80%, they want them down 90%. They could be down 90%, they want it at zero. It's never enough for those folks. And they always get too greedy in the end, and that's why there's a reason when you look at the Forbes list, tell me how many short sellers, tell me how many bears are on that list. You're not going to find any. You're not going to find any, okay? None. Look at the top 100 richest people in the world. Tell me how many were short sellers and got there. Zero. That's how many. Zero. There are people that ran businesses or invested long in real estate and stocks. That's who gets there. Hedge fund managers, all those sorts of folks, like that's who run that list every single year, right? And so always keep that in mind. Look at Michael Burry's net worth. From my understanding, he came from a very privileged background, extremely privileged background. Check out his net worth. That would be all you need to know. Appreciate everybody joining me as always. Much love. I appreciate everybody. Thanks for being subscribed here. 23,000 and maybe 200 subscribers. And also make sure you check out our insane once-a-year sale we're about to have on Valentine's Day for Become a Master Stock Market Dividend Investing Mastery. That will be a pinned comment if you want that deal sent to you as soon as it drops on V-Day. Peace.